Hey, what's up, everybody, and welcome back. All right, let's just jump right into it because the US economy right now is sending out some seriously confusing and mixed signals. Seriously, it's like your car is telling you to hit the gas and the brake at the exact same time. On one side, prices for everything are climbing steadily, but on the other, the job market is starting to look, well, pretty shaky and uncertain. So, what in the world is actually happening, and what does it all mean for your money? We are going to break it all down right now. So, let's start with the first piece of this complex puzzle: inflation. You see this number, 2.9%. That's the latest annual inflation rate. To put it simply, the everyday stuff you buy every day is, on average, almost 3% more expensive than it was just 1 year ago. That is the fastest pace prices have gone up all year long. And that's a huge deal for your personal wallet. Okay, but here's the surprising curveball. In the very same breath that we got that high inflation number, we also got this troubling report. 263,000 Americans filed for unemployment for the very first time. That is a massive and concerning jump, the highest number we've seen in almost 4 full years. It's a flashing red light that companies might be starting to cut back significantly and lay people off. So, how are we supposed to make any real sense of this confusing situation? Well, here's our detailed game plan for today. We're going to look closely at why this is such a confusing mixed signal. Then, we'll break down the impossible, difficult choice the Federal Reserve is now facing. We'll get into how this whole stressful situation is squeezing your wallet tightly. Then, we'll talk about the surprising potential solution that pretty much everyone is now expecting. And finally, we'll discuss what this all really means for you personally. All right, let's get deep into it. What we're really looking at here is what you could call an economic double whammy. It's like a powerful 1-2 punch that makes things incredibly difficult for the folks in charge of policy. And believe me, it directly affects every single one of us significantly. So, here it is, the central core problem. On the left, you've got consumer prices going up faster with the biggest single-month jump we've seen since last January. But at the exact same time, on the right, the job market is hitting the brakes hard, with those jobless claims surging suddenly to a 4-year high. Normally, these two things just don't happen together like this. When the economy is strong, you get rising prices and a ton of jobs. When it's weak, prices fall and jobs disappear. What we have right now is kind of the worst of both possible worlds. And all of this complex situation brings us to the main character in this whole economic drama, the Federal Reserve, or as you know them, the Fed. They're the ones who have to try and fix this difficult mess. And right now, they are stuck completely between a rock and a hard place. They're facing what feels like and truly impossible choice. So why is the Fed in such a tough, tight spot? It all comes down to something called their official dual mandate. These are the two main jobs that, by law, they absolutely have to do. Job number one, keep prices stable, which means keeping inflation around that 2% target. Job number two, make sure as many Americans as possible have a good job. Now, think about it carefully. To fight rising prices, they have to slam the brakes hard on the economy. But to help people find jobs, they have to hit the gas pedal. The problem is right now, the economy is telling them to do both at once, simultaneously. And that leads us directly to the billion-dollar question. What does the Fed actually do when its two primary important goals are in a head-on collision, when fighting high prices could cost people their jobs, but helping the job market could make prices spiral even higher uncontrollably? That is the delicate razor's edge they are walking right this very minute. Now, let's be perfectly clear. This isn't just some high-level abstract economic problem for people in Washington to worry about. This has a direct, very real, tangible impact on you and your family's budget. Let's talk about how this whole situation is squeezing your wallet painfully. I mean, you're already feeling this deeply every single day, right? Over just the last year alone, the price of coffee has shot up more than a staggering 20%. Meats are up over 5% significantly. Just keeping the lights on in your house now costs over 6% more. And look, these aren't luxuries we're talking about here. These are absolute necessities, and they're taking a much bigger bite out of your monthly paycheck. And it's not just one or two things going up slightly. The price hikes are spreading everywhere. Just in the month of August alone, groceries jumped a sharp 6%. That was the biggest monthly spike in almost 3 full years. Gas prices shot up nearly 2% more. And shelter, rent, housing costs, that climbed too steadily. When food, fuel, and the roof over your head are all getting more expensive at the same time, simultaneously, you feel it fast and painfully. And here's the other half of the tough squeeze. And this part is absolutely crucial. It's not just that prices are rising steadily, it's that our pay isn't keeping up pace. You might have gotten a small raise, but once you account for inflation, the actual real buying power of your paycheck has seen its lowest growth in over a year. It just doesn't go as far as it used to anymore. It's like you're getting a hidden pay cut in disguise. So, with prices heating up like this rapidly, you'd think the Fed would be laser focused on cooling things down immediately, right? You'd think they'd be hitting the brakes hard. Well, this is where the story takes a really surprising, unexpected turn, because it looks like they're about to do the exact complete opposite. This recent quote from an economist at Morgan Stanley just nails the Fed's new thinking perfectly. It says, right now, inflation is a key subplot, but the labor market is still the main story. For months and months, inflation was enemy number one. But now, with those jobless numbers spiking, the fear of a really bad recession is taking over priority. The main story has officially flipped from fighting prices to saving jobs. And listen carefully, this isn't just a random guess. It's what the entire financial market is betting on heavily. That huge 90% number you see there, that's the high probability that traders are giving the Fed to actually cut interest rates next week. That is about as close to a sure thing as you can get in markets. It tells you that Wall Street is completely convinced the Fed has made its final choice: protect the job market, even if it means letting inflation run a little hot temporarily. Okay, so a rate cut looks like it's coming soon. What does that actually mean for the economy and, more importantly, for your personal bank account? Let's walk through what happens next, step by step. So here's the official game plan the Fed is hoping for desperately. Step one, they cut interest rates significantly. That makes borrowing money cheaper for everybody involved. It means cheaper car loans and mortgages for you and cheaper loans for businesses to invest and grow their operations. The hope is that this encourages companies to hire more people or, at the very least, stop laying them off en masse. But, and this is a huge but, there's a major risk involved. Pumping up the economy like this could mean inflation stays higher for much longer. So the price of gas and groceries, yeah, they might not be coming down anytime soon, unfortunately. And that leaves us with the ultimate economic cliffhanger. The Fed is basically a circus performer on a high wire. They're trying to save the job market on one side without letting prices completely spiral out of control on the other side. It is an unbelievably delicate and risky balancing act. And the big million-dollar question is, can they actually pull it off successfully? The answer to that is going to affect all of our wallets directly. And that's exactly where we stand today. It's a complicated picture for sure, but hopefully this breakdown makes a little more sense of what's going on in the economy. Thank you so much for watching. If you found this explainer helpful, do me a huge favor and hit that like button below. Make sure you're subscribed and ring that notification bell so you don't miss our next breakdown video. I'll see you in the next one soon.